Hey everyone, welcome back to my channel. Today is November 1st. I want to say blessings to you all for making it to a new month to where we can grow, learn how to become better people, better investors, and take our understanding, our knowledge, and our wisdom into the future in order to help us and others on this investment journey. I wanted to shout out all the people who watch my channel, all the people who have wished me good thus far, and all the people who tell me that they're tuning in, they're listening to the content, that they're getting good information from the content. And although slowly, I do see that my subscriber base is growing. And so I appreciate everyone who definitely hits that like button and subscribes to the channel. And again, I just want to say it's a great feeling to have made it into a new month. We're in the month of November. It's time to give thanks. It's time to also celebrate some new wins when it comes to loans, because Fannie Mae has now lowered some of their requirements on the FHA loan, which we're about to get into in this video. So again, if you haven't already, please make sure to leave a like, subscribe to the channel, and hit that notification bell so that you're notified every time I drop a new video. So this is not new news, that Fannie Mae is lowering their requirements to 5% now in order to get multi-family housing, within 2 to 4 units, of course. Now, for all of you who don't know, 2 to 4 units can still be considered residential. What does residential mean? Residential means that a first-time home buyer like you and me can go out and purchase a property that is 1 unit, 2 units, 3 units, or 4 units without it being considered commercial property. Commercial, like a business or a bank or any physical structure that is typically used to conduct business. So a fourplex, a triplex, a duplex, and a single family home can all be considered a primary residence, even for a first-time home buyer or for someone who is not a first-time home buyer. For all of you who are not familiar with my real estate investment strategy, it is to use up my primary loans. So for example, I know every loan in the book when it comes to buying a property as a primary housing unit rather than an investment structure. Why is that? Is because it's the cheapest and easiest way to entry with the least amount of requirements and the best interest rates possible. So if you're looking to utilize my strategy and you're interested in knowing more, then you definitely should subscribe to this channel, because that is something that I talk about frequently, and it will give you the best chance of knowing what I know as well as being notified so that you can get that knowledge and get to that money. If you don't do anything else, I would tell you to subscribe for that reason if you're interested in that type of content. Now, how many primary residents can you have? A lot of people don't know how many primary residents they can have. The answer is you can have up to 5 primary residences. Now, there are some extenuating circumstances to where you can have more than 5. For example, you can only have 1 VA loan. However, there are circumstances when you can have more than 1 VA loan, right? People don't talk about these things. I know this because I am very knowledgeable, but a lot of people don't know this. For example, if you're a military veteran, you buy a VA property in Oklahoma, and then you're shipped to Texas. You buy a VA property in Texas and you don't sell the one in Oklahoma, they're going to allow you, banks will allow you to keep 2 VA properties. Let's say you move from Texas now to New York and you buy a property in New York. The banks will allow you to take another VA loan and use it in New York. I would consider that goodwill from the banks because you are active duty, you are being deployed to a new area, and just because you don't want to sell your primary residence as someone who is traveled and deployed often, it makes a lot of sense as long as someone is paying the mortgage that you can qualify for a new one and still utilize that VA strategy, right? And so I see that banks are less stringent on that requirement when you are active duty. Um, However, I'm not active duty, and most likely the people who are watching this video are not active duty. So I'm not going to get too much into VA loans, although I do have one at my disposal which I haven't used. I'll tell you how I can best use that later on in this video. So again, if you haven't already, like this video because I'm giving you guys the source. Like I always tell you, I'm going to give you the source. I'm going to give you information that nobody talks about. I'm going to give you the information to be smart, rich, financially savvy, and be able to do things that most people talk about doing but don't actually implement. All right. So right now in this market, I'm seeing a lot of houses go for sale, for sale, for sale, for sale. Why is it all going for sale? There's plenty of reasons why a property may go for sale. A lot of the times, the houses that are going to be going for sale in this market, especially in 2023, is going to be the houses that maybe don't have a mortgage on it. So no one is truly tied to that 2 or 3% interest rate. They don't care what the environment is because they don't have a mortgage in the first place. So they just want to maximize their profits. They know that housing prices are the highest that is going to be. And they also know that housing prices will come down because of interest rates, right? So if we're at the peak of the market right now and we expect prices to drop maybe 5,000, 10,000, or even 15,000, some people might be looking to sell. Now, if you're in a bigger tax bracket and you're buying $1 million properties, people are definitely going to try and sell $1 million properties, 1 million, 2 million, 3 million, 4 million. Why? Is because less people are able to afford those type of properties, and when you have rates at 8%, you're going to see drastic drops in order to get more buyers who can actually afford the deal, right? So a $5 million property can easily go for $3 million in this market. That's how the rich get richer and the poor get poorer, right? A $200,000 property is not going to drop to 100,000, right? But when you're playing with big money, the drops are much bigger. It's no longer $2,000 drops, $5,000 drops, $10,000 drops. You're now in an environment where there's not many people with that type of cash flow and assets. So when I was always looking at commercial properties and big primary residences, when you're looking at more than $2 to $3 million, you're definitely going to see big price drops, price cuts of 500,000, 400,000. I'm even seeing some price cuts of 100,000 in markets where housing is about 700,000 or $600,000. So yes, we're actually seeing $100,000 price cuts already. Why is this 5% loan something to think about or even consider? So, if you've been listening to me, you know that we're all about creating an opportunity. If you are using your money wisely, if you're saving your money, you're going to create opportunity for yourself. If you're not saving money, you will not be able to capitalize on any opportunity that presents itself. Because of this, you will never ever really be able to get ahead. You're not going to be able to take ownership of a stock that drastically goes down in value. You're not going to be able to buy the house that's on sale for 20% less for no reason but because the owner wants to get out of the house. You're not going to be able to invest and get that compound interest and multiply that money. You're not going to be able to do those things. And why is that? Is because you don't save money. So yeah, I mean, just following the statistics, especially in black households, the savings rate in 1980 used to be 4%, whereas now The saving rate during the pandemic levels was at 10 to 15%, and it has been abysmal now, not only in the black community but in all communities. It's completely abysmal. People are now living off their credit cards. People are no longer able to save. People are going on strike all over the place. Why? Is because they're not able to keep up with the cost of living, the cost of inflation, and they're not able to keep up with their lifestyle. And so, before things get any worse, they're saying, you know what? I'd rather go on strike because I cannot pay my bills. I cannot feed my family. So, with that being said, let's get straight into our loan types and why it may be advantageous for you to use this new FHA loan that's coming out November 18th. So, when we're looking at loans in November 18th, we're also looking at interest rates at 8% or even above 8%, depending on where your credit is at. With a FHA loan, you may be able to get a loan at about 7%, which to me is a horrible loan to get at 7%, because that is essentially like going into the stock market and investing at 7% returns. I can do that with $400,000 cash rather than give it to the bank for 7% and hope to get maybe 2, 3, 4% returns on that money. Because unless there is a significant price drop, I don't foresee how you're going to be able to cash flow significantly more than what you're actually paying the banks. And because of that, I personally would not just go outright and purchase a FHA property, knowing that there's going to be permanent PMI and things of that nature. If you don't know what PMI is, that's private mortgage insurance that does not drop off. For the same 5%, you can get a conventional loan that has PMI as well, but the PMI drops off after you earn 20% of equity in the house, rather from appreciation or from just simply paying down the mortgage. Now, some people might be saying, okay, so why tell us about this FHA requirement if a 7% interest rate isn't going to be good enough for you to get into the deal? Why would I want a deal at 7%? Well, there's going to be several reasons why this might be advantageous for you. So, for example, if you're new to the game and you want to get a multifamily unit, you don't have your own residence already, and you want to start house hacking, or you want to start building some equity without necessarily having to pay the full mortgage yourself, you can definitely look at a duplex, a triplex, and even a fourplex. And depending on your market, a fourplex may be a beautiful, beautiful home. Personally, here in Ohio, I am in love with the triplexes. I don't have one yet, but I would definitely love to get my hands on a triplex. And so, based on your area, this may be a very, very great way for you to enter real estate for the first time without you having to front up all the money every single month. You get to learn things, you get to work with things, and it's just a great opportunity for you to get your hands on multifamily for very, very cheap. Now, some people might say, but if I was a first-time home buyer, I can still use the FHA at 3.5%. That is absolutely true. However, if you're like me and you went conventional first because you didn't want the PMI, well, this is a loan strategy that you can definitely use in the future. So, for example, I'm also someone who is interested in assumable loans. I talk about that a lot on my channel. A lot of people still don't know what assumable loans are. Assumable loans is when you assume someone's mortgage, meaning I can assume not only their payments and their mortgage payments, but I can also assume their interest rate. And you're able to do this with a FHA and a VA loan. So because I know VA is 0% down, that is a great opportunity for me to purchase a house with literally 0% down. The problem with the VA loan, however, is that if I was to use it regularly, I would be assuming that at a 7% interest rate. Now, I can use my VA loan to assume a mortgage that is at 2 or 3%, and I'm going to have to front up a lot of cash. However, I get into this home using that VA loan, and I get that very, very cheap interest rate. I can still do the same thing with FHA, or I can wait for interest rates to go down, and now I can use the FHA loan at 5% or whatever on a multifamily property. Similar to VA, you can do the same when interest rates go down, and even use 0% to get to the properties. But again, having all of these options, having all of these loan strategies is definitely, definitely, definitely important to understand and then to utilize in the right way. So now you can start asking yourself questions. What's better for me? To use the VA loan on this, where I'm not going to have private mortgage insurance, where I'm not going to have to front up too much money up front? Or is it better for me to use the FHA loan and do it this way? This is just giving you more options, more opportunities as a primary home buyer, primary residence, in order to access this capital. Now, some people might say, how do you have 5 primary residences, or how do you get to 5 primary residences? Well, that's a great question. Most banks only require you to live in a home for up to 1 year, 12 months. And if there is a circumstance in which you no longer can live in that home for whatever reason, most of the time they'll just ask you to write a letter, and then you can go ahead and purchase a new property. So for me, when I purchased my first home, the very next month I went into the Army. Because I went into the Army, the banks favored that because, again, we're American here, right? You're not going to shun someone for serving their country. And so when I finally got out, which was about 10 months later, that wasn't just a year, but it was a lot of time for me to be away from my property, but not up to a year quite yet, right? And so I had to write in a letter stating why I was no longer able to be in that property, and why I needed a new primary residence. And of course, I did not want to sell the primary that I had. And so they used that debt to income ratio plus the rents to understand, okay, this person can afford to take on a second home. And thus, I took on a second property. And that's how you get to your second primary residence. Now, as I was waiting to acquire my third, you need to take that year into consideration. However, we all know that the market's changed. Interest rates have risen significantly. And so that impacted my ability to get a 3 or even a 4% interest rate in 2022. So it would have been late 2022, like late November of 2022. I believe interest rates may have been around 5 or 6% at that point. And it was just very, very difficult to find deals. It was abysmal. And that truly, truly impacted my ability to expand my portfolio. But again, as you're saving money, you're going to create opportunities for yourself. So now, sticking with the FHA loan. For those who don't know, buying multifamily property used to be you had to put 15, 20, or 25% down, even for residential units of 2, 3, or 4%. Why? Because most of the time it will be considered an investment unless you're living in one of the units. So a lot of people would tell you that you need to use your FHA first at 3.5%, because for most people who don't join the military, this is going to be the cheapest option for you to get into a $100,000 duplex for 3.5% down. That's only $3,500 plus closing costs. Maybe you're all in at $6,000 for a $100,000 property. If it's a $200,000 property, $12,000. If it's a $300,000 property, $18,000. If it's a $400,000 property, $24,000. So you get the gist of it. $24,000 to get into a $400,000 property isn't too bad. But when you got to put down roughly $80,000 to get into a $400,000 property, now that is almost 4 times more expensive, right? And then it's also going to eat away at your liquid cash and funds. So what does this do? This hinders you from being able to maximize your cash flow opportunities. It hinders your ability to expand more greatly, right? And focus on the appreciation. It hinders you from being able to be more liquid and fluid within the markets, and it hinders your ability to fix up the property because you have a lot of cash tied up. And so, being able to free up cash can also be a way of being risk diverse, some would argue. However, also putting a lot of cash into a property can also be a way of being risk diverse depending on the person and depending on their risk assessment and the way that they manage risk and the way that they feel about risk, right? Because the less cash you have in a deal, the less risky it is. The more cash you have in a deal, the more risky it is. And vice versa, depending on who you ask, they may feel as though the more cash you have in a deal, the less risky it is because the monthly payment and the mortgage is cheaper. And so again, it really depends on the person to person and who you ask. For me, I do believe the less amount of cash you have in a deal, the less risky it is. However, I also believe that you must have the income to support um, having less cash in a deal, and you must have numbers that support not having as much cash into the deal. If I am not cash flowing what I want to cash flow, I would definitely put up a little bit more cash in order to get that number that I'm looking for that would make me comfortable and make me feel as though this is a property worth having and worth keeping long term. As we all know, with the rise in interest rates, it is much, much more hard to cash flow. And so putting a little bit more cash in the deal, as cash is king, we want to be able to get more of that cash out every single month on a monthly basis, which will allow us to look good not only to our creditors, but it will allow us to feel good personally. Um, so again, that's just a few things to think about. Now, I don't want to bore you to death with a whole bunch of other loan strategies. Just know that the FHA is allowing you to use multifamily properties and use a loan at only 5% down now for 2, 3, and 4 units. So this is a great, great, great opportunity for you if you've already purchased a home before to now still be able to get a multifamily with 5% down or with closing costs right around what, like 7% of what the home is worth. This is a great opportunity for you all to think about this. It's a great goal for you to start saving towards, because when interest rates do go down, as the Fed stated, interest rates will go down in 2026. I don't see that this loan program is going to just dissolve itself. It's still going to be around. So if you don't have the money now and you're saving for 2026, now you're creating an opportunity for yourself to buy properties cheaply when interest rates are less and less people are clamoring for housing, because the frenzy has died down over time, right? When no one is talking about it, you're going to see less demand. And so this creates an opportunity for you in a depressed market when rates are falling to now purchase a house at 5%. I mean, it's great. I like to look into the future because we're here to invest for the future. You're getting content right now that's going to help you in 2026. If that isn't a good reason to like this video, then what is, right? So we're now timing the market. We're now looking at what we're going to be able to do further down the line, how we're going to save for that. If you want a house, if you want this multifamily property, if you want all this, all you need is 5%. And if you want 5% of a $700,000 property, you got to save for that plus closing costs. If you want 5% of a $500,000 property, you have to save for that plus closing costs. If you want 5% of a $400,000 property, you have to save for that plus closing costs. No matter what your income is, if you have enough cash, you can afford that property. So again, set that goal for yourself. I want 300, 400, 500, 600, 700, 800, 900, $1 million property, whatever it is. Set that goal. I'm going to have at least 8.5% of that money in cash, so that I can then purchase the property that I want to buy in that price range. And then when that time comes, I'm going to continue to save. But now we're going to be looking at what that is actually going to buy me within that price range, right? And so again, this comes out November 18th from Fannie Mae and Freddie Mac. It's a great option for people who already have a primary residence and they're looking to get a second, third, fourth, or fifth. And I truly believe that this will help us get ahead as a people when we're trying to maximize our dollars, maximize our budgets, and maximize our investments. The banks can be your friend when you have this right here. So go ahead and use that wisely. If you like this video, make sure you leave a like, comment, and subscribe. You know I post every single day at 8 a.m. daily on YouTube and on Rumble. And I can't wait to see you on the next one. Peace.